Welcome in, folks. It's the buy one, get two free here on the Reaction channel today. First video up here, our favorite bull, Tom Lee, says if the Fed tightens further, the banking crisis could fuel panic in the market. So we'll hear what he has to say in regards to that whole clip there, and I'll react to that and kind of give my perspective. Okay, second clip I'll give my perspective on is this one here. If the Fed keeps raising rates, you're going to have a lot more banks in trouble, says Mark Mobius, and I'll give my perspective on that one. And then the last one, which I think is going to be really interesting to get into, is why Carvana's debt deal could be a sign of trouble for other companies. And I think this is a very important subject because obviously a lot of companies are hanging on by a thread right now. Let's just call it what it is. And I mean, there's a lot of them. It's not a small list. It's a massive list of companies that are hanging on by a thread, but you're trying to figure out, like, are they going to make it? Are they not? And are either going to have to take out a lot of debt, or they're going to have to dilute shareholder value, obviously, and issue more shares. So I think it's an important subject. We'll watch that one, react to that one, and I'll kind of share my perspective. Thanks for being here, folks. I need to turn on my fancy lights behind me, man. I was going to record this video outside, but Lord knows, Vegas has to be windy like every single day, and especially where I record. And so, it's tough. Also, thanks to everybody that subscribed to the channel. 24,800 plus subscribers on this channel. It's always a new record. I appreciate y'all. Thanks for being here. Glad you guys enjoy the channel. Let's get into this.
Driving higher today, the stock surging nearly 30% at one point.
We'll just start with Carvana. We'll change it up for today, okay? We'll work our way backwards. We'll start with Carvana. We'll work our way backwards.
After the used car retailer put out early guidance and a plan to restructure its $9 billion debt. Karen's been digging in on the details of this one. She's got the fine print. Karen, what'd you find?
Yeah, so this was sort of interesting. I mean, it was good. It sounded like they're going to lose money less quickly, I guess. So the street loved that. But then they announced this exchange offer. We all know they have way too much debt. And this exchange offer is, you're not getting money for your bonds. You're getting new bonds, and these are called cash pick toggle, which means they can either pay in cash interest, 9% in this case, or they can pay you pay in kind, meaning we're not going to give you any cash interest. We're going to give you additional bonds of these bonds as a dividend at a 12% rate. Sounds good, right? Yeah. And then we can toggle, meaning we can go back and forth between cash or this pick part, depending on how much cash we have. However, the good part about it is they said, we're going to pay you a value of 80 cents on the dollar. Now, that's a discount to par, but these things are nowhere near par. So let's look at several tranches of Carvana bonds. So I can't tell. Do we have one that went up a lot? No. Okay. There we go. The one that went up a lot. This is like when you're at an airport and they say, we're going to board in groups. And whoever boards first, they get the overhead luggage space.
Right.
This is what they're saying here. We're going to board, you're going to get this exchange offer in groups. The 2025 debt that's due first, you get the first shot at it.
That's a great metaphor, by the way. I can see the scramble.
Right.
The overhead.
So they're scrambling. There they are. They're positioning themselves, boxing out Group 2. They're in Group 1. $500 million of Group 1 bonds. So that's why they're up so much. The other ones are like, we're gonna get crap. We're not, I mean, maybe we'll get a little bit off in the exchange offer, but not really. And then we're left with this still very indebted company. They've paid a little out the door already. This is no good. You can understand why Paulo and PIMCO are not happy with this. It just seems to be trying to push off bankruptcy.
Let me say this. That's ingenious. That's ingenious. A beautiful, beautiful plan. Let's just be honest. Like, Carvana's biggest thing is just survival at this point, right? It's not about like this or that. At the end of the day, survival. They need to survive as long as possible, right? To hopefully make it to the other side. The other side means actually becoming a viable company, which is clearly not right now, right? Wow.
When Tim and I went to college together, there was a class I took called Management Science.
Oh, MIS.
Which was a brutal class, and I wasn't prepared for a test. So I went into Professor Iglarsh, and I gave him a menu of reasons why and things that maybe I could do. That sounds like what these Carvana people are doing. They're throwing all this stuff against the wall, hoping that something sticks. It didn't work out all that well for me in management science on an exam, and I guarantee it's not going to work out all that well for Carvana shareholders. Just my opinion.
No, I'm sure it didn't work for you, and that probably wasn't the only class.
Yeah.
But
for Carvana shareholders, like, this is viable option. It's either zero or something, right? So would you rather have zero or would you rather have something? For Carvana shareholders, they'd much rather have something than a zero situation, bankruptcy, right?
Extending, and Carvana's got a series of debt instruments, but the point is extending near-term maturities, and that's really all they're thinking about.
And they're just praying for, hoping for time.
And they also pre-announced, and they actually had something relatively good to say, which is that they burned between 50 and 100 million versus 295 last quarter. So this is part of that story there, but it's not what I'm chasing.
I want to see at the end of the quarter, this current quarter, with more vending machines than they did, which is what they did the last quarter, which just boggles my mind.
Yeah, interesting situation. So in regards to that, I think it's important because this just goes to show you how many different options public companies really have at their disposal to get themselves to hopefully a day on the brighter side, right? Which is profitability, which is a company actually being a viable, real company, meaning they make profits. They actually, can stand on their own 2 feet. They don't need to constantly dilute shareholder value or constantly take out debt or do bond instruments. But there's so many different options out there. And so I think a lot of times people think like, it's just easy to put a company in bankruptcy and to go to zero. No. Is it very possible to get a stock to go down 70, 80, 90%? Yes. But that last 10 to 20% is vicious. Okay. Let's say it was at a $10 stock. To get it to $2 or $1, possible. To get it to zero, very, very difficult. It's actually a much more difficult process than I think a lot of people realize. And you can see it because there's so many companies that are like what I call almost like zombie companies that stay afloat for a long, long time. It's like, how is that company still around? How are they still making it, right? JCPenney's was a good example of a company that, was always that company for me that I was like, how are they still around? Like, it was crazy. Alrighty, next video up here. If the Fed keeps raising, you're going to have a lot of banks in trouble. This is an interesting subject. Systemic risk. Let's talk about this.
Yes, veteran investor and founding partner of Mobius Capital Partners. And Mark, you've got an international view of everything that's happening. But when you look around the globe right now, are you more concerned about the inflation?
I got to say, Mobius and like that whole suit, like it's just so fitting with the name. It's just so fitting.
Problem,
man.
or are you more concerned about what's happening with the financial sector and stability?
Actually, there are two things we're concerned about. One, of course, is the banking situation, because what's happened in the U.S. and in Switzerland is really a great concern for international investors, particularly the big investors who trust the big banks and who think their money will be safe. So there's really a lot of concern about that, which I think is why gold has gone up a little bit. And also Bitcoin, believe it or not, is seen as somewhat of a safe haven, I suppose, by many people. But that's one thing. The other thing, of course, is what's happening to interest rates. And these, of course, are interrelated, because if the Fed keeps on raising rates, then you're going to have a lot of banks in trouble who are sitting on long-term bonds that are being priced at lower and lower prices as interest rates go up. So these are the two big concerns we see internationally. You can see emerging markets index has underperformed recently again because China is down, but then Taiwan and Korea are doing pretty well. There are a few other markets that are doing pretty well, but there's still a tremendous amount of uncertainty out there. And I think it's going to be that way for quite some time now.
Yesterday, we had Kevin Warsh on the show. He is a former governor at the Federal Reserve, and he said it really doesn't matter if the Fed raises another 25 basis points at this point, that the damage has already been done, and it's not going to be that different. That doesn't sound what you think. Sounds like you are much more concerned if they do raise rates, it will cause additional pressure.
Exactly. I think there will be a lot more pressure. Of course, they've come to the rescue, but at the end of the day, we're not only talking about the U.S., we're talking about the global situation. And if you look at Switzerland, which was considered such a safe haven for so long, they're under question now. So I think this is something we have to look at very carefully. And there may be a retreat to other areas of the world, such as the Middle East. The Middle East banks, rich with petrodollars, might be a safe haven. But again, that's a big question mark. I would say there's still a lot of uncertainty out there.
Mark, have you moved money into things like the petro banks?
That's interesting. He just said Middle East banks and safe in the same sentence. That's a different frame of mind, man. We're living in a different time. That's interesting.
No, I'm very, very skeptical of banks generally, even the petro banks, because they're so opaque. You really don't know what's going on behind the scenes, as we've learned now with the situation in the U.S. So I stay away from banks generally. But in terms of keeping my money, my cash, yes, investing, no, but keeping cash in some of these banks, yes, that's not a problem as far as I'm concerned. And I've got an account in one of the banks in the Middle East, in Dubai, and I think they're pretty safe. But again, you have to be diversified. You can't put all your eggs in one basket.
You have talked, I think, recently about how you've had problems getting money out of a bank in China. Is that still the case? If you can't go to European banks, if you're worried about all these places, where do you think the safe place is to put your money?
Well, thank God that I've been able to get that money out of China. It just happened just today, as a matter of fact. So I'm really happy about that. But you must remember that all these countries have foreign exchange controls with very complicated sets of rules. And sometimes if you're not able to meet the documentary requirements, then you have problems. So I think you have to be pretty well diversified. I'm looking more and more at Asian banks. I'm here in Singapore, and I think the banks here are in pretty good shape because the bank rules are very tight. But again, you have to be diversified. You can't put all your eggs in one basket.
Yeah, I mean, okay. In terms of banks, let me run it down. Or, JP Morgan first, okay? They're in with the Fed like this. Always consider JP Morgan first. After that, if we're going to speak about if you're trying to diversify out of countries, I think Singapore, definitely a good option. I think Switzerland, good option. Outside of that, not so much of a fan, to be quite frank. Maybe London, but honestly, yeah, that's about it. That's all I'll say about that. Outside of that, that's just my 2 cents on that, okay? Tom Lee, let's get into our favorite bolt. Tom Lee, all right, what's he got to say here?
Managing partner and head of research, Tom Lee, he's out with a new note saying, and this is quite the headline, that a 25 basis point hike today is both bullish and bearish, and that stocks, they might rally anyway. Tom, quite the opinion here. You're known as a big-time bull here. So explain this. No matter which way we go with the Fed decision today, you're seeing a rally?
Well, Frank, I'd say that the probabilities are higher for a rally. And I think Steve made an important point, which is that even though
Tom Lee, you had to screw us, man. Stocks ended up tanking at the end of the day. Why'd you have to do this to us, Tom?
Market's been kind of resilient. There's been a huge tightening of financial conditions in the credit world. The best way to see it is the MOVE index, which is basically the bond VIX, is that it's still at 160. I mean, that's like a 50 VIX. And we know there was almost a black swan-like failure of many hedge funds last week in credit. And so the Fed, I think, has to be cognizant that if they do something that further tightens financial conditions, and it means that stocks actually fall, this banking crisis could fuel more panic. So I think that investors know this. They've been cautiously positioned, which is a point we've made. I think that the fact that bond VIX has told us financial conditions are super tight there. So I think whatever Fed action they do is not about how much they raise, but it's their desire for financial conditions to not get worse. And I think that's why stocks could actually rally today post-FOMC decision.
Okay, interesting. Now, I think something very important for everybody watching this to understand, okay? And I know almost everybody watching this, if you are an investor in the market, which you more likely if you're watching this video, you're an investor in the market, right? You're an investor into stocks. Maybe you're in index funds. Maybe you're into individual stocks. If you watch my content, you're probably more into individual stocks, right? Maybe you're into crypto, things like that. What most folks don't pay attention to is certainly the bond market. And you heard Tom Lee just talk about the, basically kind of like the VIX for the bond market is basically screaming like the VIX for stocks if it was at like a 50, let's say, for instance, right, which is insanely high. And you heard Kathy Wood. We did a reaction to Kathy Wood. One of the things that Kathy Wood talked about on yesterday's video on this channel, right, was bond investors had the worst year they've had in like 200 years, she gave an example, right, which is absolutely insane to even think about. And so, nonetheless, we definitely had a tough, let's just call it a tough, brutal 2022. For us that are in stocks, right? But I can tell you, bond investors potentially got it even worse than us, which is kind of almost shocking to think about, right? But that's the sort of stuff you're going to see when you have the Fed completely change trajectory from Fed funds rate of 0 to we're skyrocketing interest rates. You're going to see that sort of collateral damage, right? And you're seeing some of that play out obviously in the banking system. Tom Lee's here is talking about some potential panic, that could come into the market, right? If more panic comes in the market, I tell you that's not bullish for equities, at least in the short term. That's bearish short term. So, but Tom Lee always has a way to twist almost everything, bullish. And I've gave this example on a Tom Lee video before, right? To be a bull in the market, you don't have to take Tom Lee's stance in terms of thinking everything means market up in the short term, right? And, I'm always bullish on the market for the long term, right? Short term, you're going to have to deal with what you're going to have to deal with in the short term. But you can easily be a bull over the long term and believe stocks are going up over the next 3 years, 5 years, 7 years, right? And take advantage of deals out there in the market without having to go to the Tom Lee extent of somehow always something bad is good, always everything means stocks up short term, because that seems like it's almost always the position that Tom Lee takes, and it's just kind of come on, man. We don't need to take that position, right? Take the position of being a long, take advantage of deals in the market if those deals are presented to you, right? If stocks go down big and you got a bunch of deals out there, take advantage of those deals. You don't have to believe that the stock market is going to go up over the next 3 to 6 months to believe the stock market is going to go up in the next 3 to 6 years, okay? And so there's a divergence in bulls, and we gotta separate those, and I think that's very important for everybody to understand, even whether you're newer to the market or you've been in this market a while.
All right, Tom, let's just flesh out your note a little bit. You say in the note that many people on the street believe only oblivious investors are still in equities right now, but you say that equities could actually be a leading indicator. So what are they indicating? Give us a sense of what you believe they could be indicating right now.
Yeah, I think there's a lot of ways to look at it. Year to date, leadership has come from technology and FANG. FANG is up 30% this year. Early in December, we said we thought FANG could rise 40% this year. That's pretty big signal to us because, one, these are stocks that generally do well if the market believes interest rates are actually starting to decline, which is the case, or if we're avoiding a recession. It'd be tough to be long FANG if we're going to be tipping into a recession. And more importantly, FANG and tech were the first stocks to really fall out of the sky in 2022 as inflation was rearing its head. And now they're starting to show leadership. And by the way, that's 40% of the stock market is really tech and FANG. I think that the inflation story has kind of legged lower. That's why Fed futures have broken. It's not just the credit is tightening and that's going to slow inflation. I think the inflation psychology is broken. There's not stories now of inflation in the media, and then I think that means fewer people are going to be asking for raises. And, in the venture world, they were probably 30% of all new job creation. I mean, that's slowed down for now. So I think even the Fed's going to get some cover from weaker job creation. So I think that's a real story thing is that structurally the market bottomed. By the way, this was the pattern in 2008. Tech began to lead as early as November 2008, and that signaled that the internal bottom was in.
So 2 reasons, in my opinion, why big tech has roared back. And it has nothing to do with Tom Lee just stated there, in my personal opinion, okay? The 2 reasons are this. One is almost all those companies are cutting employees, and many of those employees are people that make a lot of money. Let's call it between all the different compensation, a lot of those employees make $200,000, $300,000, $400,000. When you add it up upon thousands or even tens of thousands of jobs being cut, it's an immense amount of profitability those companies are going to basically see come through over this next 1 to 2 years. Okay, and obviously that's long term. So those companies really watching their pockets. Let's call it that. Okay. The second reason why those stocks have come back so strong is almost all of them got massively oversold to ridiculous levels. Should Meta have gone down to below $90? No. Should Tesla went down to $100? No. Should Shopify went down to $25? No. You go through all those stocks. Should AMD went to $55? No. Should Nvidia went to $110? No. Okay, so you can go through all those stocks. They got way oversold. Should those stocks have sold off at least a little bit? Yes. They also should have sold off between 30 and 50%, all those stocks. But the problem is many of those stocks sold off between 50 and 80%. And you're talking about that's a substantial difference. And when you're talking about going through a vicious market like we went through in 2022 where the NASDAQ fell at the peak, it was down like 37%, right? You're going to have some stocks that get massively oversold. And that's what we saw. And now it's kind of like a rally back from like where those stocks should be trading. Metastock, I think Metastock deserved to go down to $180, $190, $200. But down to $80? No. Did Tesla deserve to come down to the $200 level or $150? Sure. Did it deserve to go to $100? No, that was way oversold. And so I think that's an important factor there. I appreciate everybody joining me as always. Thanks so much, folks. Thanks everybody that subscribed to the channel. Thank you everybody that supports the channel and supports my content. If you get value out of it on Patreon, you can also see all the moves I'm making out there on the Patreon. That's going to be pinned comment down there. Also, if you're looking to apply to join my private stock group, private wealth group, check out the description area. That'll be for an application down there. Much love and have a great day.